Hey, everybody. Welcome to, this is going to be so much fun. It only makes sense on week 150 that we have special guest, former IRS agent, Andrew Bosserman. So good to have him with Shoemaker Law. And he has been here before. And we do have the ever-present Jack Santinello, and he is behind some sort of an interesting background. So we'll see what, this will be good. And so we're going to be talking about taxes and the tax man and some really crazy stuff. And so I'm wearing my "Don't Tread on Me" because taxation without representation, right? So we're going to be talking, and I know Adam's going to get really wound up. But first, Jack, why don't you say something so people can see where you're at?
Well, see, that's how I got myself in trouble, because I started doing some searching on how to stay out of jail, and then they put me in jail. So here I am.
So this is going to be fun. So the theme on today is what happens when the IRS starts knocking on your door, and what can you do to prevent that? And I think we actually have some expert legal advice from LegalZoom that Jack is going to tee up for us as well. So he has gone to the Wikipedia for lawyers, evidently. So you guys know the drill. Hit us up with Q&A, hit us and harass us on the chat. Yeah, Derek's already doing it. Jack again. Yeah. So Adam, I know that there are plenty of things going on in the world of craziness in Washington, D.C. And evidently, since they're going to be abolishing the IRS and doing a flat tax, which will never pass, but nonetheless, you probably have some thoughts about that too.
Yeah, it's funny because I'm going to share my screen now, Gary. You should be able to see a screen now with my chicken scratching.
Oh yeah, Tom and Jerry. I love those guys.
Yeah. So, there's always kind of a, hey, that seemed like a good idea at the time, or hey, that sounds like a really good idea. And like somebody will inevitably come up to me at a party and say, we're going to pass a flat tax and put you out of business. I'm not really worried about that because, frankly, I don't like doing tax returns any more than you like paying for a tax return. So that's why we focus BGW on better things than just completing tax returns. It's all about helping people make money, save money, stay out of trouble, and have fun doing it. Right, Gary?
Amen to that, brother.
All right. But anyway, what I did want to get into in terms of like, hey, why would a flat tax, why is a flat tax unfair? I mean, because a lot of people think, flat tax, the ultimate fairness. It's actually horribly unfair unless you do everything as a flat tax that's possible. So what I drew up here with these examples of Tom and Jerry, just so our listeners can stay informed when it comes to the subject, is just, two examples. Tom, stupid cat, partied too much, in high school, failed out, never got his diploma, made some bad choices, maybe, or maybe made good choices. Maybe he's a social worker. I don't know. But either way, he's not making as much as Jerry. Tom's making 50 grand a year. Well, when we hear about flat tax, that's really at the federal level. So in both these scenarios, both Tom and Jerry have 3 kids, but in Tom's scenario, he doesn't really pay federal income tax because the child tax credit, the ability to exclude a certain portion of income due to itemized deduction. So he only pays 1%. Of his taxes in federal income taxes. And at some point, he needs to pay his fair share. Getting all those handouts. He needs to pay his fair share because Jerry, making $1 million, worked hard, got a good education. He's paying 30% effectively with the same set of facts and scenarios. So obviously 1% is a whole lot less than 30%. Jerry is paying a lot more in income taxes than Tom is. However, if you just look at the other taxes that both of them have to pay, just to keep the system running, they both have Social Security taxes. On Tom's income, that's going to be about 7.5% of his 50 grand. On Jerry's income, because the Social Security is capped, and then still has a surtax, but it's a lot less percentage. He's at about 1%. State tax is the same for both of them. If they're living in North Carolina, it doesn't really matter. So there you go. There's your flat tax. Property taxes as a percentage of income, assuming Tom lives in a, $150,000 house and Jerry lives in a $1.5 million house, property tax for Tom are about 3% of his income. Jerry, it's 1% of his income. Sales tax, assuming that Tom spends a couple grand a month in Mecklenburg County, assuming Jerry spends, $5 grand a month in Mecklenburg County. For Tom, it's 2% of his income. For Jerry, it's 1% of his income. Sorry, 0.5% of his income. And then when you look at gas and car, because they both drive on the public roads, right? We all pay a gas tax. When we go to fill up our tanks with gas, for Tom, that represents about 1% of his income. For Jerry, it's not even like, you can't even, like, it's a fractional percentage point, in terms of his $1 million income. So, for Tom, all in, if you just calculate what's Tom's all in effective tax rate, it's 19.5%. For Jerry, it's 37.5%. So you can look at that at face value and say, man, that's unfair. Jerry pays a lot higher as a percentage, especially at the federal level where the biggest difference occurs, than Tom. If, however, your solution to this was to raise Tom's rate and lower Jerry's rate, it's pretty clear to see what's going to happen. Tom is going to have less money in his pocket each month, which is really today only $3,000 a month after tax, after all taxes, not just his federal taxes. Whereas Jerry, it's $52,000 a month. Let's say that hypothetically, hey, we can all get behind a flat tax of 20%. Sounds totally fair. That's gonna kill Tom, and it's gonna benefit Jerry. I mean, it's just freaking math, So unless you were to change the entirety of the regime to be some sort of you'd have to abolish every tax at every level, and then redo the entire system from scratch, which is why, I agree with Gary, it's like, we'll never do that, so we're kind of at where we're at with the progressive. This is why we have a progressive tax system, is to solve for this problem. Now you could say, look, I mean, there's some stuff that we should probably do around Tom. Maybe is there stuff we should do about Jerry? Maybe, but this problem is really why a flat tax won't work unless it's done in conjunction with every other tax that each one of these guys has to pay, because just at the end of the day, it's just math. I mean, it's inequitable to poor people. I mean, it's just, and you could say, geez, maybe they should earn more money. I don't know. I mean, that's more social commentary, but this is why the math doesn't work, because the bottom would end up paying more and the top would end up paying less in a flat tax regime that only focuses on the federal level. So that's just commentary on why the flat tax will not go anywhere. Go ahead.
Yeah, so the one thing that I was going to say, Stuart Varney, probably my favorite English speaking business commentator, he was interviewing a Republican that was kind of pushing this flat tax thing, and they're saying 23%, and he said, Stuart says, yeah, but in my country where I left, England, they did a consumption tax, which is a sales tax.
Yeah,
but they didn't abolish anything else. So he said
just add on.
It was terrible. Like, it was like, I hope to high heaven you are proposing that. Well, blah, 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 blah. So,
yeah, no, I know. I mean, that's the whole point. Like, in the UK, so I'm pretty sure Stuart Varney's from the UK, right? He's not from Australia.
Yes.
Okay, yeah. So I mean, in the UK, if you do the same analysis, the effective tax rate is more like around 55%. But you also have free education and free healthcare. You could argue if they're any good or not, but it's just, you're getting more benefit from it. So then the other thing I wanted to hit on in, the opening rant is Biden's budget that he's proposing in terms of the tax rate increases. This is really what he's targeting, which is incomes at, basically the boogeyman is anybody making over 400 grand. I mean, that's generally where he's targeting, and always has been, targeting incomes over $400,000. His big primary change that are going to affect, pretty much most of our listeners is that he wants to change the net investment income tax, which, most of our clients don't really pay unless they're doing some pretty heavy stock sales currently. But he wants to change that net investment income tax. First off, he wants to raise the rate up by 1.5%. And then the second thing he wants to do is he wants to make it taxable on all income, not just investment income. So this would be wages, partnership income, S corporation income, presumably. Like, he hasn't laid out any specifics, but that seems to be the direction that it's heading. Which, if you just look at that last part, I bracketed it on the wage, partnership, and S corporation income, that effectively for most of our clients that make over 400 grand would equate to a 5% surtax on that they're paying, that they are not paying today. So 5% tax rate increase under the Biden plan. When people talk, it's going to kill businesses. I mean, I'm not saying one way or the other about whether this is good or bad. I'm just saying the reality is going to be about a 5% increase if it goes anywhere, but it probably won't. But this is Biden's plan to shore up Medicare, Social Security. On the other hand, if you listen to the announcement from Nikki Haley about Biden just wants to raise your taxes, and I like Nikki Haley, by the way, but Biden just wants to raise your taxes. No solution but raising taxes. What I'm going to do instead is I'm going to raise the retirement age on young people, and I'm not going to give benefits to rich people that don't need them. Well, Jack, correct me if I'm wrong, but if I raise the point at which you can collect the benefit and or I take away the benefit that you were otherwise going to receive, isn't that just a tax rate increase by another freaking name?
Yes, that is.
Yeah, it's a classic Republican move. Classic Republican move. I'm not going to raise your taxes. I'm just going to take something away. So it's like, where's Grover Norquist when we need him? Where'd that guy go? Vanished from the scene. So anyway, I actually favor, personally, I kind of favor Nikki Haley's plan, over a tax rate increase. But it is a tax rate increase, not anything other than that. It's just, packaged up a little bit different than anything else. And then the second thing that he's proposing too is he's got the corporate minimum tax. I'm a fan of some version of that because it's unfair that Duke Energy won't have to pay taxes for 150 years based on their deferred tax liability based on previous tax incentives they've accumulated. But I could go for 10 years not paying taxes, but 150 years is a little ridiculous. But the billionaire tax basically is the other thing he's targeting, which is basically saying, look, if you're a billionaire and you made a lot of money in the stock market effectively, or, selling real estate or whatever, so not selling real estate, but through real estate appreciation, stuff like that, then there ought to be at least some form of minimum tax that exists, whether you realize the gain or not. So I always get these TikTok videos, Jack. I don't know if you get like the equivalent of the TikTok legal videos, like, here's Timmy in his basement telling me, how to set up my operating agreement. But, my version of that is, sorry if this is offensive, but, the really hot chick explaining how to be like a billionaire and never pay taxes on TikTok. I get that. Hey, does this apply to me? I get at least 5 of those a month. Well, the way that's happening, everybody has the ability to do this today that has an investment account with any sort that's being held by any investment brokerage house. Basically, what you're doing there is, Gary, if you've got $1 million, sitting in an investment account that's earning, 10% appreciation, right? But you haven't sold any stock, it's just appreciated. So $1 million goes to $1.1 million. Well, you don't have to sell it if you don't want to. You still made 100 grand. but you don't owe any tax because you didn't sell it, right? So then what you can do is you can take a loan typically for up to 75% of that value. So you could, in theory, make $100,000, not be taxed on it, borrow $100,000 from against your own portfolio and not pay any taxes. So when they're talking about how the rich don't pay, that's what they're talking about. So what Biden's talking about doing here is just saying, hey, look, can we stop this nonsense? Because at that point, Gary, I mean, there is a scenario where you could never pay taxes. When you die, if you didn't do a lot of creative estate planning, you might have, your heirs might have some taxes, but in your lifetime, if you did well, probably paid some taxes to get to that point. But once you're at that point, you could effectively never pay taxes again if you didn't want to. It would be voluntary, at that point. And that's really what he's talking about, shutting down. I don't think that's going to go anywhere. Even if that's a good idea, it would be so as Andrew would attest to, this would be so complicated to track at the IRS that it just, there's no possibility it could go anywhere. I don't think. I mean, they'd have to do, they'd have to make it applicable to everybody, So anyway, that's my tirade, Gary.
That was pretty good. I liked it.
Well, you didn't yell at me, so I appreciate that.
No, I actually agree with everything that you're saying. So since we have this guest appearance from Andrew Bosserman, who was an IRS agent, and if you've been on Confessions of a Former IRS Agent before, you've heard Andrew and some of his stories, which is fun. So Jack, thanks for helping tee that up. And Andrew, thanks for joining us. What I would love to do is start, Andrew, with things that the IRS does not do when you think that you're getting hey, you need to call this number or whatever. Let's talk about some of the spoofs and what not to fall for, thinking that it's the IRS coming after you. And then I want to move into, all right, knock, knock, IRS is here. What do you do? And then we'll go into some of all right, so how do we avoid that? So, right?
Perfect. So the main thing to remember is that the IRS will generally send you a letter in the mail to let you know you're being audited or if there's an issue with your tax return. So if you get a phone call, and someone says they're the IRS, be skeptical. It's probably not the IRS. They used to make phone calls, but I'm pretty sure the general guidance in most situations now is they send a letter first. Same with, I've even gotten text messages or emails saying, oh, you owe money to the IRS. But yeah, don't trust those either. That's, someone over in Africa trying to get your money, most likely. And generally the IRS won't just show up and knock on your door. If they do, the only possible exception is that those are IRS criminal investigators, which are essentially law enforcement like the FBI. And if that happens, you're in trouble. So that could happen, but hopefully not. And I mean, that looks like what happened to Jack. IRS criminal investigator showed up at his door and, he didn't request legal representation and, now he's in jail. So if someone shows up at your door, definitely get legal representation quickly. Otherwise, wait for that letter in the mail to contact the IRS. And you can always verify someone who says they're an IRS employee. They should have a badge number they give you every time they talk to you, and you can call the main IRS number and verify that their identity and they are who they say they are.
Yeah, that's good. And Jack must have done something really bad because it looks like he's in Alcatraz, man. I mean, that paint is lead paint and he must have been eating it, it's chipping off. So
They serve coffee though.
Is it any good?
Not really.
Yeah, well, there you go. Even though it's in San Francisco, outside of it. So yeah, actually we know somebody, and I won't name them, but they were on the Anything But Typical podcast, and they actually had IRS agents show up at their place, and they were terrified Actually, we've had two people on the Anything But Typical podcast that had the same thing happen, and they're both clean, but I don't remember, they were both different circumstances, but that has to be frightening. You kind of said it in passing, but I want to kind of reemphasize that you said you want to have representation with you. So who do you want? Who do you call?
Yeah, I mean, you call someone like me, I'm an attorney and, former IRS agent, or also, a lot of times individuals will have their CPA represent them as well. Really, you want someone who's done this before. It's not, generally you get a better result if you get representation because, people like me or Adam, we've dealt with lots of IRS agents over the years and we know how the process works. And, we know where, potential pitfalls are, just really ways to, handle the process from beginning to end with just hopefully, resolve it in your favor. So, and also if you get representation, you generally don't have to meet with the IRS. Otherwise they'll oftentimes, request that they have an interview with you and come out and view your place of business. And generally we can get them to waive that, which makes it easier on you as well and lets you keep doing what you're good at, running your business and not, having to deal with an IRS audit.
And I would add to that a few things, and not just for the IRS, but any federal or state agency that contacts you and wants to have a friendly conversation with you. It will be friendly, it'll seem friendly, and they will try to get you to do things that you're not required to do. And the challenge is that you may be completely clean, but there, and you may be willing to say, okay, yeah, go ahead and open up, you get pulled over, open, I don't care if you open up the trunk, you can search every part of the car, whatever you want, kind of thing. But, you need to be careful with that because there's certain processes and procedures that should be followed because you have certain rights. And by you giving your consent in that moment, you may have waived those rights to later do something that you would have been instructed to do or not do by legal counsel. We fortunately have some of our partners that have former government, also have governmental experience, meaning a former assistant U.S. attorney in our Columbus office, and recently had a client who was a different federal agency reached out to her to ask some very friendly questions. And I was like, okay, I'm fine with it, but I want to go talk to my partner about it. He said, absolutely not. She is not going to talk to anybody without having legal counsel present. And even if it's a Zoom call, that they're on there. So that way it is, if they try to guide you into some, rabbit hole or something along those lines, that you don't fall into that. And so, and it's just really more preventative. And again, not that you're doing anything wrong or have done anything wrong. It's just that I could see in this particular instance where they might ask questions and she may not have knowledge of certain things, but she may have knowledge of rumors. And so now they start drawing her into telling hearsay rather than things that she knows, and then draws her further into the matter rather than saying, this is the extent of the information that I know firsthand, period, put it in a box and you're done. So just be aware of that as well. Not trying to upsell you on services, but I mean, it's the reality that how they operate, which is being friendly until it's time to drop the hammer.
Yeah, I mean, oftentimes, the cost of our services is cheaper than a massive, tax bill that you might accidentally walk into. So,
and Andrew,
go ahead.
Before we got on the call, we're talking about the employee retention tax credit, and I mean, I'm like, it's funny because I kind of, we partner with somebody that's been pretty reasonable at ERC today. At the same time, these credits had a finite shelf life in the sense that they weren't going to run out of money, but the statute of limitations to claim them is coming up for the first batch of them. So it's like, from my own perspective, not like a lot of filtering's going on here, because I'm getting blown up via text telling me what an idiot I am for not claiming my employee retention tax credit. Yet there's been some articles about, hey, look out on this. You mind kind of sharing your thoughts on what's been shaken in employee retention tax credit world from the IRS and the government's perspective?
Yeah, so personally, we've seen a decent amount. We've been evaluating ERC claims over the past few months on behalf of clients in other scenarios. And we have seen, there's a lot of tax credit firms out there that seem to do like none or minimal due diligence to see if you qualify, but they'll, promise, large credits and, oh, of course you qualify, and they're going to take, 10 to 20 to 30% of your credit. And, they're incentivized to, get you to file the credit and, hopefully get the money and then leave you high and dry when the IRS comes knocking. So it's definitely important if you're doing it. You don't need a tax credit firm to, file the employee retention credit. I mean, they have done a lot of it, so you can use them, but I mean, your payroll company or CPA, it's a pretty simple tax form to file once you have the calculations. But from the guidance I've seen is that the IRS intends to audit these claims very heavily. It was released yesterday or today from the IRS Office of Professional Responsibility, which basically governs people like attorneys and CPAs who practice before the IRS and anyone who files a return with the IRS. And it basically said that, we're going to be coming after individuals who are filing ERC claims when they shouldn't be or haven't done the required due diligence. Also, the fact that I believe Em can correct me if I say this wrong, but I believe some of the periods for 2021, the IRS has actually extended the statute of limitations to audit ERC claims an additional 1 or 2 years, I believe. So, I mean, that right there just shows me that the IRS is intending to look at these closely. And another thing I would mention is that a lot of times these firms will say, oh, well, the IRS currently is auditing a very small percent of these claims. Like, we call this the audit lottery. Like, don't play the audit lottery. We can't, if we advise you to file something wrong just because there's a low chance of, being audited, like we could lose our law license or accounting license. So don't do that. It'd be the same as, someone telling you, go ahead and break the law, or commit that crime, the police won't find you. So that's what Jack was telling his clients. And then, they did find him. So don't be like Jack.
Yeah, that's pretty funny. As I was regaling my family members with the stories of my multiple stupid arrests as a child, I made sure to let them know that on one such occasion, when I tried to defend myself in a traffic ticket, the judge pointed out that I was taking but if nobody saw it, was it really a crime defense? Which, my stepmom showed up in court with me just to laugh at me for that one. So yeah, we get that a lot. But what if I don't get caught? It's still wrong. God will know. So.
Yeah, Andrew, you just introduced a new thing on week 150. Just remember this, folks. Jack, first say something. Whatever.
I think I know what you're going to say, but go ahead. Yes.
Don't be like Jack. It'll land you in jail.
Yes. A caveat to the companies that are out there, the scammers. So it's not a scam in that they're going to take your money and not do what they say. They're going to take your money and do what they say. The problem is what are they saying they're going to do, which is very minimal. And if you read the fine print, it's also going to say, we are just a conduit. We are taking your information, kind of meshing it together in a format that is acceptable for filing. We're not validating the information. We're not making sure that you know how to do math. It may be that they expect you to send the numbers in Excel format, but they're not going to check your formulas to make sure. I mean, and I don't know that for sure, but so there's a lot of there is a lot of disclaimer and waiver language in those agreements. So just be aware of that. And again, there are good ones out there, and as BGW is using one of them, and so but the scams do continue. And you'll get phone calls and it'll sound official. You guys probably get this as well. On my phone, like Chase Bank, and it just says Chase, and it looks very official, or B of A. But then you go and you pull up the actual email address, and it's some at Yahoo dot CA or AU, Australia, Canada, whatever it is, and you're like, okay, obviously not. So it's not just in this context; it is in every context that we're being hit up with some pretty good scams. And I say, and I remind all of you that, for the younger generation that maybe doesn't have street smarts as much yet developed. And on the other end of things, the elderly, our parents, our grandparents that are just, very trusting, because that's where they grew up, being very trusting in an environment and not having things hit them that are constantly looking legitimate. They must be legitimate. I mean, look, it's the official logo. So please, at every opportunity, please share that with your loved ones in both directions generationally, to just, keep your antenna up for those kind of things.
Yeah, that's good stuff. With regard to, they come knocking, you call and phone a friend who happens to be your CPA or a tax attorney like Andrew, and they're with you. Then you go down their process as they see fit or as advised by your counsel. The question that I've got is, all right, so what are the things that somebody can do, back up the tape, to hopefully calm down the blood pressure and the heart rate before that, or to even try to do what they can to avoid the audit?
Yeah, so let's first talk about ways you can prepare. And first, I think it'll be helpful to kind of explain how an auditor thinks. So if we think about how your tax return gets prepared, you're taking all these source documents, entries on your bank statement, credit card statement, receipts, and you're putting them into your books and records. And that could be a system like QuickBooks or an Excel spreadsheet, or even something more sophisticated like Peachtree or something like that. And then you give those financial statements, which, profit and loss, balance sheet, general ledger, to your accountant, who then translates that information and puts it on your tax return. So that's the process you go through to prepare a tax return. An IRS auditor is going to do exactly the opposite process, follow it from the tax return back. So they're going to look at your tax return, and they're going to point out a line item, say, wages or car and truck expense or something like that, and ask, like, how did you calculate that number? So you want to be able to trace it all the way back to the source document. So, you go from the tax return, and generally there's, if you use a CPA, there's a report called a tax line reconciliation prepared, which basically shows what accounts in your book translate to what line items on the tax return. And then once you, as you're tracing backwards, you might see an item on the tax return consists of 3 different accounts. For example, supplies expense could include, office supplies, factory supplies, etc. And then you want to be able to go from that account to your source document that proves it. So that could be a credit card statement, a receipt, an invoice, anything like that. So, you could even test that out on your own, just take last year's tax return and start thinking like an auditor. If I wanted to audit this one line item on my return, this expense or this income amount, can I trace back all the way to my books and records and then to my receipts? So a lot of it is just making sure your documentation's in good order, and you can track everything and prove your expenses or income if the IRS comes knocking. And also making sure you're organized now and that's in order will definitely prevent a lot of stress if it comes time for an IRS audit, because you know that you're keeping good books and records. You won't have to spend lots of time preparing for the audit. It's more so just, pulling the files out that you need. So that's really preparing for it. I don't know if Adam has any additional comments, but we can also talk about kind of avoiding one, but preparing is definitely important.
Yeah, no, I mean, people kind of get frustrated. Like a lot of times we get, well, how long do I need to keep, blah, 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 blah. And the answer is like, even with, well, technically, should you keep original receipts? Yeah, you should. But at the same time, generally, if you've got credit card statements, you might get asked for original receipt. I've never had that happen in an audit, but you could. I've had it happen in sales and use tax audits, but never in an IRS audit.
Yeah, I remember that came up, and we would always accept credit card statements.
Yeah.
I mean, it would be good to have the original receipt, but also the other thing nowadays is you can, I would just scan everything in, all the paper documents, save it in some Dropbox or cloud format. You don't actually have to provide, the original hard copy of a receipt. A scan or something else suffices. So it makes record keeping a lot easier. But
yeah,
go ahead, Adam.
where I was going with that though is that we always harp our clients to have good financial records, which for us means records I could stand behind, meaning they're reasonably accurate. And frankly, that's driven off the fact that at the end of the day, as Andrew mentioned, the IRS asks you for a bunch of stuff. It's like your bank statements, credit card statements, and stuff like that. And like, if your bank statements don't reconcile, that's a red flag. Pretty basic. You say you only have this much cash, but your bank says you have this much cash. That doesn't seem right.
Yeah.
So you claim this much in payroll, but your 4 payroll tax returns that you file with the IRS says that you only had this much. Like, it's stupid stuff, but that's generally the way. There's a lot of things that I don't like that happen sometimes in an audit, but generally the thing that I do like that happens in an audit is they're very reasonable in the sense that, not to get into the basics of financial statements, but if you can verify your balance sheet, there's only one variable left on it. That's what your net income is. So, you're then at least forcing the debate on, was that a legitimate business expense or not? Which typically, we can win if it's not crazy, versus like, whole thing's wrong and I'm hiding money. Right, which is where you don't want to be.
Yeah, and that's I've even seen, Adam mentioned a good point about balance sheet. Like, having an accurate balance sheet and making sure everything ties out and is reconciled is extremely important, because I've even seen people file returns with balance sheets that don't balance. And if there's going to be a red flag, that might be one, because it clearly shows that your books are wrong. You have an error somewhere. So yeah, I definitely agree with everything.
So we have a question that I want to hit in here, and you tripped another thing that we see that's common. And I just heard it this morning after I was at a speaking engagement. And that is, oh gosh, yeah, we got this big deal looming, and we've been so busy, growing our business. It's a software company, but yeah, our books are not, like our accounting. Yeah, well, guess what? What we've seen, pretty much everybody thinks, unless it's a real train wreck, oh yeah, our books are good. Yeah, they're good, and pretty much nobody does. It's all varying degrees, but even we've had some really big clients. Oh yeah, they're tight. Everything's tight. And then we get into it and it's like, they're not reconciling well. And to your point, if you want to drop the temperature in the room, drop your blood pressure, make sure that it's tight, and because you're prepared. So let's go into the question.
I just have one comment on that. I mean, you may have talked about this before, but FTX, the crypto firm that blew up, they were using QuickBooks to essentially keep all their books and records, and weren't doing it properly. So that's the poster child of what not to do. If you're running what was the value of that? Billions of dollars, I forget how much. If you're running that large of a company, please don't use please don't use QuickBooks.
Yeah. Yeah. And just because you have QuickBooks and just because you know how to log into QuickBooks doesn't mean that your charts of accounts are accurate. So, here's the question from David, and it goes back to ERTC. So it says, regarding ERTC, my company is an S Corp. We recently received 2020 Q4 ERC check. I had to fire my business partner in 2021. His resignation letter states he is not entitled to any further compensation. Do we have to amend our 2020 filing? And if so, is he entitled to any of the ERTC funds?
On the first question, yes, you do have to amend your 2020 filing because it is taxable income. What you decide to do with that, I'll turn it over to Andrew and Jack to get disbarred.
Go to Andrew because
Too late.
Jack's in jail.
Yeah.
No, I mean, so yeah, so like Adam said, you'll need to amend your 2020 filing. Some, I mean, is going to depend on, the agreements. It sounds like there's a resignation letter, but I mean, are there agreements, but any other agreements between you? I mean, it's taxable income. Well, 2020 needs to be amended, right, Adam, for the wages to reduce the wage income.
Yeah, that's
But in
right.
terms of you receive the income in this year, so assuming you're on the cash basis of accounting, that would be, 2020. What year are we in now? 2023 taxable income.
Okay.
So, yeah, Jack, I don't know if you have anything else to add to that, but I mean, it sounds
Nope,
like
I'm already in trouble, so it's all good.
income in this year.
Don't be like Jack. Okay. Yeah, so let's do a little bit more and go a little bit deeper on what can you do to prevent, the audit.
So I'm gonna, before we go into what really matters, I have
Yeah.
some lists that I pulled from, some really important resources. And I think you mentioned one of them. So
Were you logging on to the internet while you're in the jail cell library?
yes, they actually allow that too. The internet here sucks though, but it's, so it's kind of slow.
AOL.
Circa like 2000 internet. All right. So I pulled, and here's also, I'm going to share my screen because as I go through this and I was thinking about sharing this, I was thinking, okay, this is what I would imagine Andrew doing on the ones that he says are incorrect. Remember that guy?
Yeah.
Wrong. Okay. So now that you have that mental image, remember, what's his name? McLaughlin? Yes. From Saturday Night Live. You're making fun of, I think he was on Fox maybe. Okay. All right. So
It looks like Dana Carvey.
it is Dana Carvey on Saturday Night Live. Yes.
Yeah.
Making fun of. Okay. All right. So here we go. 10 ways to avoid a tax audit from the very authoritative LegalZoom. Don't report a loss ever. Okay. And again, you can probably hear the sarcasm in my voice, but okay. So, and feel free, Andrew, anytime to yell out the word wrong at your discretion.
Yeah, I mean, on that, I will just take that first one. I mean, if you have a legitimate loss, you should definitely report it. You've paid taxes when you have a gain, like you're entitled to get a tax deduction when you have a loss. So
Yes.
I know the worry there is the whole, hobby versus business. The IRS likes to reclassify things you claim as a business as a hobby if you have too many losses in a row. But the presumption is if you show a profit throughout 5 years, you're a business. But you can overcome that presumption because there's plenty of businesses. Like, for example, I work with a decent amount of Christmas tree farmers, and it takes 8 to 10 years to grow a Christmas tree. So like that's a massive startup period. You're showing losses. And if that was a bright line rule, they would all be reclassified as a hobby. But you can overcome that presumption by showing this is a legitimate business. This is just a really long, startup or pre-productive period. more often this comes into play when it's more of a side business or something like that. But yeah, I mean, always report loss if you're entitled to it because you get a tax benefit from it.
All right, so I'm gonna read the rest of the list, and you pick one or two, or maybe one that you want to talk more about, whether sarcastically or actually. So be specific about expenses, provide more detail when needed, be on time, meaning do not be late on filing your return, avoid amending returns, match up all your paperwork, don't use the same numbers repeatedly, meaning year after year for certain deductions, don't take excessive deductions, use a Schedule C, and don't leave questions blank. So according to LegalZoom, those are the most important things to avoid a tax audit.
Now, hold on. Adam, you got to weigh in on this. Avoiding amended returns. Do amended returns really draw? And Andrew, chime in on this one.
If you're so the answer to that is no, you should amend a return, for sure, if you do some money back. But at the end of the day, they're also input into the system manually, and if it's for something that happens to be on, kind of the watch list for whatever reason, and you didn't claim it, but now you are, then, you might get. What I've had happen in that scenario is I've had what's called a bench on it, which is basically just saying, hey, look, you didn't claim this deduction. Now you're claiming it. Can you give us kind of your reason why? Like a good example of that would be the R&D credit. I did it, I didn't do it. Somebody found it. Now I want to claim it. I go back, I amend the returns. I've never done it before. My industry code is not one that it's like, alarm bells, this should qualify for research and development credit. I mean, I could see a scenario where the IRS says, hey, we just would like to double check your answer, please. Can you tell us why you decided to do that? That's perfectly reasonable, but not a reason to avoid doing it.
I agree. I mean, well, first of all, yeah, it depends the reason for amending. If you're amending and you actually show more tax and you pay it, like the IRS will never audit that. I mean, you're giving them extra money, so rarely would they ever look at that. Yeah, it comes time. The issue is if you file an amended return and you're due money back. But like Adam said, I mean, you attach an explanation to an amended return why you're amending. You can attach supporting documentation as well. So, I mean, as long as you show a straightforward argument of why your original return was wrong and you're amending it now, you're entitled to additional money. So I would, amend your return, if it makes sense. And I mean, the IRS will occasionally look at amended returns, but just like Adam said, I mean, I think my time as an IRS agent handled one or two. And it was in that scenario where the taxpayer is requesting money back and we just wanted to verify that, oh, you actually had this additional expense or something like that. And it was a pretty easy process. It's definitely not a full-blown audit where we're, making sure you don't have any unreported income or anything else like that.
All right, how about this one? Matter of fact, let's play another game. Matter of fact or myth? The IRS maintains that filing returns electronically can prevent mistakes and lower the odds of an audit. The error rate for paper return is 21%. The error rate for returns filed electronically is 0.5%. How about that one?
That's probably accurate.
Yeah, I mean, that's probably right. Because if you file electronically, the IRS does a lot of checks on certain things before they accept your return. So that's probably right. And also, I audited at least a few horribly incorrect paper returns where people filled it out with pen or pencil and white out on the face of the tax return. And yeah, don't do that.
Yeah, that's actually what they're referencing here. It's like, so at BGW, we're using an industrial strength tax software that performs a lot of the computation, has very similar error checks to what the IRS has in place. But I could still paper file the return. That's really not this.
Yeah.
What this is like literally, I got a PDF of the forms off the IRS website, and even if I typed them, I'm still doing all manual calculations. Bad idea.
Yeah, don't do that. I mean,
yeah, bad idea.
I mean, you should use a CPA, but at the very least, use a program like TurboTax or something to at least make sure you get the math right.
But
All right, so two more. And this is from H&R Block of things to avoid. Huge donations, but having small income. And then the other is just a general beware of how your home office use, which I think is more prevalent because of COVID. So be curious of you guys sharing what your thoughts are as far as some missteps and maybe some assumptions that, okay, I don't really have, I work maybe 80% at home, 20% at the office, so I should be able to deduct a higher amount from home, whatever those myths are. So, start with the first one, which is the huge donations with a small income.
Yeah, so for that, I mean, I wouldn't be worried about that as long as it's a legitimate charitable donation, because for example, you could have been saving money over decades or whatever, and then decide to make one huge charitable donation. Or you could actually say you inherited money and the inheritance goes nowhere on your tax return. The IRS doesn't know about it. And then you could decide to give some of that away and you get a tax deduction. So I wouldn't worry about that. What I would be more concerned about is large non-cash charitable contributions, because a lot of times I remember looking at those a lot when I was an IRS agent, and sometimes it's more so the types where people will claim donations of like thousands of dollars of household items to Goodwill or something like that. But other non-cash charitable contributions are legitimate. Like you can, a good tax planning way to save taxes, if you own appreciated stock, you can actually donate the stock to a charity and not pay any taxes on the gain you would have otherwise had to pay if you sold the stock and then donated that money to charity. So needless to say, I think the IRS looks closer at non-cash contributions, but if it's legitimate, I wouldn't worry about it. And cash contributions, those are straightforward and very easy to document and prove. So I wouldn't worry about that either.
yeah,
And before you get,
I'd kind of
sorry, go ahead.
I'd echo Andrew's comments on the non-cash contributions where it really is just a best faith estimate, so I'll give, that's not like even a car, kind of have a good faith estimate, kind of don't, in terms of like you can, so am I going with like, if I donated to my if I donated, which I did actually do, I donated my truck when it died to Cars for Kids. It was dead, motor blown. Probably a bad idea, Gary, if I use the Kelly Blue Book mint condition fully running,
It was perfect
value, because that truck was dead. Had to be towed to my driveway. So that, I think that's the kind of, so again, people get worried about these statements like, look, I mean, that would have been freaking fraud, if I did that, because that car was not worth that. It was dead.
And also, I think, I forget the limit. If a non-cash contribution is over something like $10,000 or whatever the limit is, you actually need an independent appraisal to verify.
Well, that kind of brings us around full circle into the fact that I thought that my vintage Michael Jackson Thriller child-size jacket was worth more than it was worth, and I reported that and tried to take the deduction, and so here I am.
Yeah,
along with college
It was not
sweatshirts and other
worth
stuff.
$3 million.
yeah,
I thought so.
you're in trouble. Yeah, so I mean the second, the second one that I'll hit on, that you hit on was the home office expense, and I think, on that one, I think what we find the most common is like people trying to get greedy. And because you'll find like, hey, how should I compute the home office expense? And you'll find, seemingly credible websites that would say, even if your home office is on the first floor, you should include, the square footage under the stairs that you're using for storage, in your square footage calculation. And, you know, you redid your garage because you wanted to look have it look really cool, and it serves no business purpose, but you ought to take a percentage of that because, you know, technically you might store a file box in there somewhere. It's just, that's dumb. You know, in other words, like
Only if you have a Corvette.
you could do that. Yeah, I heard that slight, Gary. You know, or I'm just going to leave papers out on my desk. I mean, either way, whatever. Yeah, they're both bad, right? just don't be an idiot.
Yeah, the important also thing to know about the home office is that, like, the rule is that it has to be regularly and exclusively used for business. So, I mean, it's hard to meet the exclusive use requirement in a lot of situations because, you know, your home office, you know, you might also use it for other purposes. It might be a spare bedroom, or you might even do personal work or work related to a different business or job in there. So it's a pretty difficult test to meet, and you want to make sure you you know, meet the letter of the law with it.
All right, and this is a sincere question, in that when you say exclusive, you mean 24/7. It isn't as if you can say, okay, I exclusively was at work from 1 p.m. to 5 p.m. 3 days a week, and I wasn't doing personal stuff. I wasn't, you know, so I was in there 4 hours a day, that period of time. So that isn't the type of exclusivity. You're meaning actually the square footage that I'm saying is my home office, that I'm not using it for anything else.
Yes.
Is that accurate?
Yeah,
Okay.
for example, like, you know, for where Gary is to qualify, he would have to do only business work in that room. So
There's nothing else to do in this room, believe me.
I've
mean,
seen
ultimately,
I've seen it. That's true. Jennifer's not going in there for other purposes, and Gary's got a whole nother room for his quiet place. Actually, he's got
That's
2
right.
rooms for his quiet place.
That's true.
Okay,
This
what
would
about
qualify.
what about some derivatives, and not to put you on the spot, meaning, okay, I pay X amount for an ink cartridge for my home printer, and I'm going to allocate 20% of that cost to business and 80% to my personal consumption. I mean, can you get that granular on things like that, or not?
yeah,
at
I mean,
all?
that's the way you should be doing shared expenses. So a lot of times we would see that with, say, cell phones. You know, you might use the same cell phone for business and work, so you should definitely split it up. You know, using a car, anything like that that's shared. I mean, even like an ink cartridge, although an ink cartridge is a pretty small expense, so the allocation doesn't make a big difference. But that is one thing we would do on IRS audits a lot, is look for expenses that are likely personal and see if they're, you know, taking the full amount or reducing it by a reasonable percent for personal use.
This has been good, guys. Woo! And, you know, we didn't trump you up out there, Andrew. So you were kind of the lucky strike extra for our listeners and participants today. Good stuff going back and forth on the chat. And yeah, so one person asked if Jack was the Birdman in Alcatraz. Yes, he is. So anyway, you guys did a great job. Next week, we got another Adam, because Adam Petrikoff, and this is going to be really down Jack's alley. We're going to be talking about kind of the mergers and acquisitions environment, current deal market conditions, and an overview, like what's happening. So for you that are running businesses that are having people knocking on your doors, or were, maybe they still are, because there's still a lot of money out there, or you're considering acquiring. This was a kind of a must attend. So Adam came from I think a 3-generation company, a family, a big business, and he's with VR business brokers, and he kind of handles a nicer range. So I think that'll be good. So Andrew, Adam, any more thoughts on the tax side before we say arrivederci?
I'm good, buddy.
I don't think so. I
Andrew?
mean, ultimately, I think the theme of our conversation has been, you know, make sure you have good books and records, and can trace everything from the tax return back and forth. And also, I mean, don't listen to a lot of these, you know, things you read online about ways to avoid an IRS audit or something like that. If you're entitled to the deduction or the credit or the expense, you should claim it, and have and be confident in that with your advisors, but also with your good documentation.
And just so you
Yeah.
know, I will be sending a link to an email with the GoFundMe account to get my bail. Since I'm in here because of all of you, trying to, set an example. So I'd appreciate that.
Well, just keep knocking those YouTube and TikTok videos out, on things, how to beat the IRS, so just do like blur the background so they can't tell that it's bars. All right, guys, thank you so much for another week 150. Next week 151. We will put this up on the BGW CPA YouTube channel later on this afternoon for anybody that came on late. Take care. Have a wonderful rest of the day. And it's beautiful. Get outside. Bye-bye.
Thank you.
All right, see you guys.